Hello, welcome to our video today. We are going to discuss 5 things a beginner must know before entering options trading. So let's get started. What is options trading? Options trading could appear complicated at first glance, but it is actually quite simple when you understand it. It involves trading instruments that gives you the right to buy or sell a specific security at a specific date and at a specific price. These instruments are called option contracts and are linked to an underlying asset such as a stock or another security. They have a set time period, which can range from a day to a couple of years. When you buy an option, you have the right to trade the underlying asset, but you are not obligated to do so. This is known as exercising the option. If you are a do-it-yourself investor and have a personal brokerage account, you have full control over your trading decisions and transactions. However, you are not alone in this endeavor. There are plenty of communities that bring traders together to discuss market outlooks and options trading strategies. You could also watch our YouTube channel that covers stock market moves and options strategies. The different types of options. To form your knowledge base in options trading, start by getting familiar with the different types of options you can trade. The 2 basic categories of options to choose from are calls and puts. What is a call option in stocks? A call option is a financial contract that grants the holder the right to purchase an underlying security at a specific price, known as the strike price, within a certain time frame. This option is essentially a way for the holder to call the underlying security to them. The expiration date is the final date on which the holder can exercise their option to buy the underlying asset. Call options can come in 2 different forms, the American style and European style of options trading. American style options allow the holder to buy the underlying asset at any point before the expiration date, while European style options only permit the holder to purchase the asset on the expiration date itself. What is a put option in stocks? A put option is the opposite of a call option. It gives the holder the right to sell an underlying security at a set strike price. This is similar to putting away security. Like call options, put options also have expiration dates and can be exercised according to American or European style rules. How does options trading work? Options trading is a way to invest in the stock market through an online brokerage account. This type of trading allows individuals to make their own investment decisions. To start trading options, it's important to understand the basics, such as buying a put. A put is a contract that gives the buyer the option to sell a specific security by a set expiration date at a specific price. Before buying a put, it's important to consider factors such as the current market conditions and the price of the security in question. Additionally, it's important to consider the expiration date and the strike price of the put option. Overall, understanding the mechanics of options trading, including buying a put, is key to making informed and successful investments. How options pricing is determined. Options pricing can be calculated using different models. But at its core, options trading prices are based on 2 things: intrinsic value and time value. An option's intrinsic value represents its profit potential, based on the difference between the strike price and the asset's current price. Time value is used to measure how volatility may affect an underlying asset's price up until the expiration date. The stock price, strike price, and expiration date can all factor into options pricing. The stock price and strike price affect intrinsic value, while the expiration date can affect time value. Options trading strategies to know. Once you've mastered options trading basic concepts, you may be interested in more advanced options trading strategies. As you become more comfortable with options trading, your investing efforts may include some of these commonly used techniques. Covered calls. A covered call strategy has 2 parts. You purchase an underlying asset. Then you sell call options for the same asset. As long as the stock doesn't move above the strike price, you can realize profits by selling call options for the assets you own. Married puts. A married put strategy involves purchasing an asset and then purchasing put options for the same number of shares. This approach gives you a measure of downside protection by allowing you the right to sell at the strike price. Long straddle. A long straddle strategy involves buying a call and put option for the same asset with the same strike price and expiration date at the same time. This approach may be used when an investor is unsure which way prices for the underlying asset are likely to move. 5 things to know before you start options trading. If you're interested in beginner options trading, keep these factors in mind as you get started. 1. Options are based on underlying securities. Options trading can be applied to various types of securities, not just stocks. The most popular underlying securities include equities, indexes, and ETFs. However, it's crucial to understand the distinctions between options based on indexes compared to those based on equities and ETFs before engaging in trading. Being aware of these differences can greatly impact your trading strategy and success. 2. Options trading involves taking a calculated risk. If statistics and probability are in your wheelhouse, chances are volatility in trading options will be too. As an individual trader, you really only need to concern yourself with 2 forms of volatility: historical volatility and implied volatility. Historical volatility represents the past and how much the stock price fluctuated on a day-to-day basis over a 1-year period. Implied volatility is based on what the marketplace is implying the volatility of the stock will be in the future, over the life of the option contract. Implied volatility is one of the most important concepts for options traders to understand because it can help you determine the likelihood of a stock reaching a specific price by a certain time. It can also help show how volatile the market might be in the future. 3. Terminology used in options trading. When trading options, there are different strategies to consider, such as buying or selling calls or puts. You can also have a long or short position, which does not relate to your physical height. Additionally, options can be classified as in the money, at the money, or out the money. These are just a few of the many terms commonly used in the world of options trading. To ensure success, it is important to have a solid understanding of the terminology. That's why there are options trading glossaries to help you stay informed and keep track of all the key terms. 4. Options traders borrow from the Greeks. Options traders use the Greek alphabet as a way to reference how options prices are expected to change in the market. This is a crucial aspect of trading options and understanding how the market is behaving. The most commonly referenced Greek letters are delta, gamma, and theta. These Greek references can assist in explaining the different factors that are driving movement in options pricing and can give an indication of how the marketplace expects an options price to change. However, it is important to note that these values are theoretical in nature and there is never a guarantee that these forecasts will be accurate. 5. Options trading begins with identifying and setting your financial objective. Options traders who are successful have a clear understanding of their financial goals and desired position in the market. The way you approach and think about money will directly impact your options trading. To ensure success, it's crucial to define your investing goals before funding your account and starting to trade. This will help you make informed decisions and increase your chances of achieving your desired outcome. Rewards and risks of trading options. Options trading, like any other investment strategy, has its own set of benefits and drawbacks. It is crucial to understand these potential advantages and risks to prevent making costly mistakes. One of the main advantages of options trading is its flexibility and liquidity. In comparison to other investment options, you can invest with smaller amounts of capital. Additionally, options can be utilized to create downside risk protection and diversify your portfolio. Skilled options traders have the potential to generate substantial returns. However, options trading can also be very risky, especially when compared to buying individual stocks, ETFs, or bonds. Predicting stock price movements can be challenging, and if your predictions about a particular security are incorrect, options trading can result in serious losses. Therefore, it is essential to consider how options trading aligns with your overall goals and risk tolerance. Thanks for watching. If you liked the video, give a thumbs up, and don't forget to subscribe to our channel for more amazing content.